Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Mark Phillips, CEO of Harvested Financial, to discuss strategy execution as a service and option strategies for retail clients and individual investors through the election and fourth quarter. Mark, it's great to have you with us. Welcome to Trade Talks.
Yeah, thanks so much for having me, Jill.
And Mark, it's interesting. We've covered SaaS and other as a service companies, but strategy execution as a service is a new term. The Trade Talks audience, tell us about that and what Harvested Financial is doing to bring option strategies to individuals.
Absolutely. So what Harvested Financial has developed is a platform for individuals to select and create customized option strategies that we then execute for them as a service. So the first options robo-advisor, and this digital wealth management platform that we've built lets clients access all of their accounts and custom strategies online. By being an advisor, that means that there's no need for our clients to worry about the tedium of entering orders at a broker and managing rolling expiration and strike selection. That's all handled by us. So what our model portfolios do is they align with the various features of option strategies and provide that diversification, amplification, or protection that the client is looking for. They can further customize these on their own, but regardless, what we do is we take away the pain of implementing that option strategy. So we've seen a lot of interest from individuals. OCC volumes have been booming over the last couple of years, specifically this year, and providing that alternative return structure is something that clients want to do without the fear and trepidation of having to do it themselves. And honestly, there's probably no better example than what we're hearing about the upcoming election and what clients are asking to do about their portfolios.
And Mark, let's talk about that. Fundamentally, what are you focused on with the election just around the corner?
So it really is just around the corner, right? We only have a few weeks to go, just less than 3. And one of the themes that I think has come out recently has been a shift in perspective about what that Democratic victory might mean. So not only are we seeing some polling leads in the White House, but there are important Senate battlegrounds that are starting to shift blue. And while this traditionally is viewed as bad for the markets, the longer we're seeing the pandemic play out, market participants are speculating that an election victory for the Democrats might actually play well. Earlier this month, Goldman Sachs had a piece that forecasts a massive stimulus package and the major spending increases that would come with that if the Democrats are given a chance to put their plan into action.
Now, how are market participants reacting? And of course, the question is election insurance getting very expensive?
Yeah, and that's a great question. And I think what's really interesting about the options markets is that it isn't necessarily a way to bet on movement, but it's a bet on whether the movement is going to be more than what people are predicting. And right now, investors are pricing that insurance very expensively. So we're actually seeing two kind of effects happening right now, playing out in both the equity and in the volatility markets. So first, looking at the equity valuations, there's arguably been some run in the market due to dealer positioning in options. So there's a sort of reflexive impact where when we see heavy call buying from retail and customers, the dealers are short those calls, but they hedge them by buying stock. And this creates a sort of reflexive impact where the market continues to tilt higher based on these activity from retail call buyers. Hedging this momentum flow has these self-reinforcing effects, particularly strong in technology names like Amazon, Apple, and Microsoft. This explosion of options volume does create a tail wagging the dog effect. And depending on how dealers position over the course of the next couple of weeks, we could really see a big movement before the election. So the other angle is actually the volatility pricing. And a simple heuristic that I like to throw out for how much that insurance is really costing is the price of the straddle right now. So if we look at the Nasdaq 100 index, that straddle is pricing around a 7% move. So that straddle would be buying the call and buying the put. You'd need to see the market move more than 7% before that sort of insurance strategy would pay out for you. These levels are about the same that we saw in the midst of the 2008 financial crisis and election at that same time. So long story short, insurance is incredibly expensive and buying that is going to cost a little bit.
So what happens if the election isn't a cut and dry scenario and this thing drags out?
Absolutely. So I think the obvious thesis that people are suggesting is that a dragged out election will be a drag on the markets. And as news continues to trickle out over the fall, markets will drop sharply depending on what news is coming out. And I think that actually presents a really interesting use case for options because it's specifically a play about timing. It's hard to know when and what's going to happen. So we like to use a systematic approach here that will allow investors to stay consistently and probabilistically exposed. We call it a rolling bear strategy because it continually puts people in front of option structures that pays out when the markets drop. To the extent that a peaceful transfer of power becomes an issue, we don't know when that might happen, but we like to stay exposed to that downside volatility.
All right, Mark, and to wrap up here, what about COVID-19 and how are the headlines impacting individual names?
So if there's any storyline that could dominate the markets more strongly than the election, it would be the pandemic. And I think it's interesting to think about how that's playing out on individual companies. These two broad themes are very much macro themes, but what that means with investors focused on the large indices is that individual names can have a tendency to move a lot more violently. To the extent that there's an individual storyline, whether it's about healthcare, names of the election, or potentially financials and what the pandemic means for them, we're seeing exaggerated moves. And that's, again, a great place that option strategies can really capture those upside or downside moves against these two major storylines that are playing out in the market.
All right, Mark, thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.